We are at the beautiful Future Proof Conference in Huntington Beach. I'm with John Love, President and CEO of USCF. John, it's good to see you.
Good to see you. Thanks for having me.
Yeah, of course. Um, Tell me a little bit about the firm, the heritage, and kind of the DNA of how you all approach investing.
Sure. Well, we've been around for almost 20 years now. We launched our first commodity ETF in 2006. So we've been in the space a long time. What we wanted to do is democratize commodities for investors, make it easy to invest. So you didn't have to open a futures account, deal with margin, dealing with rolling futures, and give people exposure to things that are not correlated with stocks and bonds, and yet they're big assets, but they were hard for people to get. So we were the third commodity ETF ever to launch, our United States Oil Fund. And since then, we've launched a number of products, single commodity funds and broad commodities. And broad commodities is generally where we talk to investors about when you're looking to make an allocation, unless you track a particular market. And then we have those products for folks as well.
Gotcha. What do you think in the market these days? It feels like, from my perspective, from the journalism lens, it's been incredibly volatile months, years in the space. Have you, in your career, seen a more volatile period for commodities and international trade than what we're going through right now?
I mean, certainly the financial crisis was the most impactful, but I don't think we've ever seen so much thrown at the global economy as we have in the last 6 months. And so we're yet to see how things shake out, whether tariffs have an impact, or whether other things kind of make up for what their negative impacts are. So, and there's so many other things that are being tried, some good, some maybe not so advisable, but we'll see how it works out. It's actually, in commodity markets, commodities are individual supply demand stories. So certainly news, policies, all these things go into that mix, but they affect different commodities different ways. Whereas the stock market, it can be it can be good, it can be bad. There's relative underperformers, relative outperformers, but the stock market's going to do what the stock market's going to do. Commodity markets can be quite different. Something that affects one negatively can affect another positively. And those different supply demand stories can overpower whatever's happening, positive or negative. But that's the reason you have that diversification from stocks and bonds. So I think we've got that benefit as well.
Yeah. So if I'm an advisor and I'm thinking, how can I get more allocated towards commodities? Very difficult to go out and become an expert on cattle or cocoa, or as you just said, it's such a disparate supply demand dynamic for each. How should advisors think about commodities and how to bring them into the portfolio?
Well, we've got a systematic strategy, actually two ETFs, same strategy. One puts off a K1 and one is a 1099. So the difference is really the tax treatment. Some investors prefer with a K1, you get a 60-40 long-term, short-term split. So it can be advantageous, but a lot of people don't like the K1, so they'll choose the other one. So USCI is the one with the K1, SDCI is the one without. And we have this systematic process those strategies follow, where they look at the entire commodity universe, the most liquid commodity futures. But rather than picking, based on production weighting or liquidity rating weighting like the traditional indices do or a lot of other funds do, we pick half the universe at a time based on a market signal that we think indicates scarcity in a commodity or potential scarcity. And so we equal weight, we rebalance every month, we own half that universe. We always have one commodity in every sector. So we maintain broad diversification and a good beta to traditional commodity indices, but so far we're seeing outperformance in terms of 1 year, 5 year since inception. We're right now leading the pack. So even this year, with all this volatility, we're up 15%. We've experienced some of the volatility, but we've been somewhat diversified just based on those different stories that are in that portfolio and that we're able to allocate to based on those systematic rules.
Yeah. Something we've traded notes on is copper and cattle.
Yeah.
I know you've got a view there. What's your perspective on those two commodities?
So copper, I think, is just one heck of a good long-term story. The one caveat with it is copper does tend to be more correlated with the economy. So if you have a recession, there could be a short-term downgrade in copper. It depends. But we're starting to see just copper demand, and we've known this for years, is not keeping up with the growing supply. Data centers, infrastructure, not just the United States, but all over the world. India is doing a huge infrastructure build out. And now AI has even increased. We had demand for data centers before, and now AI is adding more. And you've got electrification, which is changing the whole electric grid. So copper's in just so much is needed, and yet new production has not come online fast enough. It takes a long time to bring a copper mine to fruition, 10, 15 years. So we're thinking there's going to be a squeeze here, and it may be a multi-year, maybe even longer than that squeeze. On the cattle side, U.S. Cattle herds have reached their lowest size since 1951.
Wow.
So it's almost 75 years. We have not had, we have more people, but we don't. We have a lower cattle count. So that's the reason cattle prices are up this year. You can't just go, you can bring a lean hogs to market in about 6 months. You can't do that with cattle. So that's also a slow ramp up to meet demand, especially when it's fallen off. You also unfortunately have some diseases coming up. They're in Mexico and South America that have not reached the U.S. And if that happens, that would further degrade the herds. So hopefully that doesn't happen. But even without that, there is a shortage. And so that's what all these individual commodity stories bring you is potential shortages, and let's we try to allocate to where those shortages might happen.
Yeah, makes a lot of sense. A lot of advisors think about gold as a protective asset. It's had a good run. Where do you see gold going from here?
I think gold has still got some room, maybe slower than it has gone up. But I think as long as you have this disruption in the global economy concerns, gold tends to, be a protection asset. So people are going are allocating to gold. And also central banks have been buying in this sort of world where people are allocating away from the dollar, and you've got global tensions. Central banks have been buying gold. They've slowed it down a little bit, but that has propped up the price or accelerated the price of gold. And it's really popped just month to date. Where today's, I think, September 9th, and we're up incredibly since just the start of August, and it was already up a lot. So, with anything that's gone up, for multiple years and is still continuing to rise, there's always the question, can it go higher, or is it overvalued? And at some point, that'll be the case. But right now, I don't see a lot of downside for gold with the economy the way it is. And so if it does kind of slow down its acceleration, or it flattens or even goes down, we have a product that has gold plus income, USG. So that would probably tend to outperform in those kind of markets. It's only a straight up market where pure gold is going to outperform. And so we think we have a mousetrap that, is ready for a slower gain or even a decline because it can put off income at the same time that it's giving you exposure to gold.
Gotcha. Do you have a perspective on Bitcoin or crypto as a kind of store of value? I know it's kind of outside the...
Yeah. Well, I mean, certainly the market has accepted Bitcoin. There's this huge crypto push right now. A lot of people say Bitcoin's a commodity. I disagree. It does, with recent regulation, it meets some of the criteria where you'd classify something as a commodity, but the bottom line is it's not a thing. It's not something that you can actually touch or physically manufacture or dig out of the ground. So I don't see it that way. As far as where it's going to go, honestly, no clue. I think the crypto market in general, when you look at everything pouring into it, people talk about AI being the .com. I feel like that's going to be the .com. I mean, I don't know what function all of it serves. Bitcoin, yeah. Ethereum, yeah, I get that. I don't know where it's going to go, but I understand that, and some of the other crypto contracts as well. There's definitely some innovation there and some use. As far as the rest of it, I don't know what the use for Dogecoin is, or all these derivatives of that. So we'll see how that goes.
Yeah, it's really proliferated. Is there anything I didn't ask that you wanted to talk about today?
Well, the only other thing I'd add to the crypto thing is, I mean, if you are a crypto bull, I said I don't think it's a commodity. One of the reasons for that is they're not correlated. They both trade independently of each other. So, in fact, Bitcoin tends to be more of a risk asset that trades with tech stocks. whereas commodities tend to often offset that. So if I was an investor, and you believed in both, then I think they can both be in a portfolio.
Yeah, both have their place.
Yes, exactly.
All right, John, thank you so much for joining us today. It's great to be with you.
Thanks very much.